joined by Executive Global Markets Trading, Tom Gale. Tom, good morning.
Hello, Addy.
It's been a while, and it's good to finally hear that voice of reason. I don't know how much of it is true or not, but Tom, let's jump straight into it. There's so much going on. Hopefully you can give our clients some direction.
Well, I'd like to. And when you say a voice of reason, sometimes that voice can be of reason and caution. As you and your audience may recall, I have been a little cautious since middle of July. Certainly markets have been hungry for risk to the point where it feels a little exuberant. The problem for being a market watcher and a trader and so on is to not only consume and assess the risks, but sometimes perhaps just to ride, know when you can actually just ride the momentum. And certainly there's been an opportunity cost if you de-risked in July. Your audience will probably be aware that the JSE had its best August in almost 20 years. So certainly there have been returns out there despite valuations globally and risks globally being a little stretched.
Well, what's beauty is that you said you throw caution, or you always advise caution. But Tom, as you mentioned, from July to now, you've kind of said that, and I mean, we called this a while ago. You said that we were in a bear bounce. We've seen market highs for some time now. I mean, the caution, 100% agree. We can see a lot coming out, especially in the US. But I mean, is this an opportunity as well? You always do allude to the fact that there is opportunity in this time of uncertainty.
Well, there's always opportunity, and that's the lovely thing about markets. What I would just say is that for sure we were very cautious or very cynical, I should perhaps add, for the rally. But we were quite clear also that you ride the rally. The rallies can be vicious. They can offer a good trading opportunity. And I think it's fair to say that we were clear that you could ride the rally at least until into middle of July. As I say, the challenge is always knowing what to do when risks are building, when valuations are stretched, whether you continue to ride the momentum or take some chips off the table. And as I said at the top of the call, my cautious streak had me take some chips off the table in the middle of July. Whether this is a bear bounce is a moot point, and I think you and I, Addy, have given this sufficient airtime in previous calls. It's a bounce. It's been a spectacular bounce either which way, and certainly globally there has been plenty of appetite for risk. Whether that is misguided or not, we will just simply have to see. I do want to start this call with a note of caution once more, and that note of caution emanates from what we're seeing in bond markets globally. So where governments are issuing debt to pay for funding for their spending, the levels, the yields on that debt in the secondary market are stretched again. The market's clearly concerned about something, and I'd summarize it by saying that there is renewed political risk, as well as a reminder that most countries, especially developed markets, are carrying enormous amounts of debt, historically enormous amounts of debt. In fact, in many cases, we've never carried so much debt. And so that does have to be priced in. Investors, those who buy government bonds, want the proportionate reward for that risk, and they will demand that reward in higher yields. And I could cover a few examples here. I won't. I want to just use two examples to illustrate the point. The chart on the left is the 10-year yield on French government debt, and as you can see, we're approaching highs that we've seen before. Now, just to remind your audience that French politics has been in some turmoil for a little time. Governments have come and gone. And typically the challenge for French governments is to get a budget in place. It's not just South Africa that struggles with formulating budgets and getting cross-party agreement. France has had far more trouble doing this, and in fact, preempting renewed trouble with tabling a budget. The French government, the current French government, has called a vote of confidence for the 8th of September. And it's really touch and go as to whether the French government will survive that vote of confidence. Typically, they will need support of the far left and the far right to remain in office. So I think France is one to watch. On the right, we've got Japanese yields. And your audience may be familiar with the Japanese debt load. It's not new news. Japan carries something like 350%. Never mind South Africa's 70 to 75% debt to GDP. Japan is multiples of that. And with inflation starting to return in Japan, the concern is that yields need to be higher, and therefore the cost of funding debt going forward is going to be more expensive for the Japanese, despite that very big debt load. Anyway, I don't want to dwell on this, except to say that it's a story that simmers in the background, and we do need to keep an eye on this in the next few weeks. Today is, of course, US Labor Day. That means it's a US holiday. So today's trading will be light, but Labor Day historically signals the end of the summer holidays for the Northern Hemisphere, for the US and for Europe. And so it really is back to business for markets after today. And at the end of this week, we'll get data from the US that covers jobs and job creation in the US, just at the time when those numbers have been rolling over, and yet prices, the chart on the left, have been rising. So inflation and core inflation has been rising again. And this presents a quandary for the Federal Reserve over its rate setting policy, because if prices are going up, but fewer jobs are being created, and therefore the jobs market is under some pressure, then, well, what should the Federal Reserve do? Well, we know that they're going to cut rates in September, but beyond that, the market expects a lot of rate cuts. We'll have to see what comes of the data on Friday and what sort of state the economy is in. But I do think that a few chickens are coming home to roost. When I talk about chickens, I'm talking about tariffs, and we can talk about Trump chickening out. Forgive my little flourish there, but there is a serious point to be made.
It's a brilliant point to make, but I mean, there was an article I kind of came across that said that along with tariffs, it wasn't done all that kosher. So,
well, you may be referring to a legal the implementation, the imposition of tariffs. And
when I say an article, I mean, it kind of came across that tariffs could be, kind of done away with. But I mean, that sounds pretty far gone. But what could that mean? I mean, in a perfect world, we have tariffs now. We have to work forward. But if you could digest it or unpack it for us.
Well, the simple point here is that following Liberation Day and blanket tariffs imposed by the US by way of executive order and using emergency powers, that was tested or challenged in courts in the US. Well, we've heard recently from a circuit of judges that the blanket tariffs, so those that are not sectoral specific, it's okay for the US executive to impose tariffs, for example, on steel, if they see that it is justified by some sort of national emergency. But the executive has really abused its powers by imposing blanket tariffs on countries. The question is what to from here, as you say. Well, it's likely that the White House will certainly appeal, but secondly, that if they find this legal road to imposing blanket tariffs blocked off, that they will find another road. And so I think for the purposes of this call today, I don't want to dwell on this point. I think that the administration, the current administration, is going to stop at little to have its way. And I think that we can get used to the idea that tariffs are here to stay. Tariffs that, by the way, are historically high. I think we've shared this Financial Times graphic before. And if you look at the little insert top left, latest estimate of 17.7% tariffs, well, that's higher than tariffs imposed initially by Smoot-Hawley Act of Congress in 1930. And so, as we've said many times before, someone's got to pay for these tariffs, either US businesses when they import, or those US businesses pass on the costs of those tariffs to individuals and people on the street. It was interesting on Friday that Caterpillar, which is a distributor of mining and construction equipment that we'll be familiar with here through the Barlow World franchise, has warned of higher net impact. They're having to revise higher the impact of tariffs on their business to as much as $1.5 billion to $1.8 billion for the full year, up from a previous estimate of $1.3 to $1.5 billion. So businesses are feeling the pinch of tariffs, and we mustn't lose sight of the fact that tariffs are a tax, and someone in the US is paying them, not the rest of the world, but the US. Okay, so there are some there are some risks still that dwell. China has shrugged off its risks for now, and I just want to talk to this briefly because I think that we positioned some product recently via the online share trading distribution that allowed investors, your audience, to invest in Chinese stocks. And China's had a good rally, a very strong rally. In fact, China's gone from being a laggard to a leader. The chart on the left shows the Chinese stock market had a very strong run through August. And it's being driven by local Chinese investors, not foreigners. Foreigners really remain underweight China because of the slowing economy. So you may well ask me, well, why is China rallying? And there's a few answers to that, but I do just want to make a point which our Chinese economist confesses is counterintuitive, and that is that with the weaknesses in the Chinese economy, which we all know is slowing and has some bloated debt that it carries, well, there are renewed hopes of Chinese stimulus. We pour a little bit of cold water on that. The stock market rally is very welcome, but we do wonder if it can persist. I'd prefer to talk about South Africa in the time that we have left, Adi. And really the message here is one of continuity. So you and I have been talking for some months now about the relative cheapness in SA, and of course the story, the narrative here, which is one of reform and constructive, supportive fundamentals. I'm going to mention, I'm just going to talk to the chart on the left here just for now, just the chart on the left, which shows terms of trade. Terms of trade, the white line, which I want you to think, I want you and your audience to think of as exports minus imports. And essentially for us, for South Africa, in substance, that is the export of gold and platinum group metals. And those prices have done very well, of course, minus imports. Let's think of things like oil, which has been trending a little bit lower more recently. So we think of that as we talk to that as terms of trade, and terms of trade, when they're favorable, should be supportive for the rand, simply because those exporters, those who mine gold and PGMs, will sell dollars to buy rands as they take advantage of the higher prices. The line in blue, circled in green, is the dollar rand inverted. That is to say, the higher the blue line goes, the stronger the rand. And you can see there, it's not a perfect correlation, this chart, but it is fundamental to what the rand is, as I say. And we do feel then that the rand still has very good support from precious metals. The other thing that that tends to dominate discussions here on the trading desk at Standard Bank is the debate around rate cuts for South Africa. Now, rates markets here are pricing in 40 basis points of cuts in 12 months. And how can we get 40 basis points of cuts? You might ask, well, what that's saying is we're going to get 25 a cut probably in September. The next meeting, and thereafter we've got a probability of another 25. But either which way, however we slice and dice this, It's slightly odd. We would expect more cuts than just another 40 basis points. Clients that we chat to think that 75 basis points, 0.75% in the next 12 months is reasonable. We do know from Lesecha Cañejo, the governor of the Reserve Bank, that inflation is expected to be temporary. The little uptick we've seen in July is temporary, and he himself, Lesecha, has told us that SARB logic is not always intuitive as they work to press for inflation targeting at the lower end of their previous band. I want to just spend a brief moment mentioning South African bonds. At the top of this call, we talked about yields on French debt, on Japanese debt. We could also talk about yields being high in UK and the US, but in South Africa, it's a very different story. And you and your audience may be surprised to hear that actually our yields have been falling. We've talked about this before, but it's a worthy reminder just to reiterate that point. South African bond yields have been falling, and that's because the market considers fiscally and in assessing our debt metrics that we're in a better place, at least, than we were a year ago or 2 years ago. And this is important for the next point that I want to make, and we're getting into the rub of this, Adi, which is the JSE and the equities piece. Our equities strategist, Deanne Gordon, who you've had in your OST podcast before, very well respected strategist on South African equities, highlights that given that South African bonds have rallied, that is to say that the price of bonds has gone up and the yields of bonds have come down, now highlights relative value in South African equities. And you and I have talked repeatedly about how cheap South African equities are, and that remains the case despite this big JSE rally. And so on almost any metric that we care to choose, South African equities trade at a discount to peers. So whilst I've been a little cautious on global risks, I want to just make the point and reiterate the point that I remain very constructive on South African equities and South African bonds, and indeed the future, the immediate future of South African markets in general. And perhaps to just zoom in on this for a moment, Adi, some of the preferred stocks that our SBG securities research team have as some of their favorite picks, their top picks.
Well, that's quite a big list. Given what you said, and just to be cognizant of time, what would you think would be the top 3 that stand out to you there? And this by no means is advice, correct? As you know, we're non-advisory, but just a top 3, because there's quite a few names on this list, Standard Bank included.
Yeah, and you're right, just to remind your audience of the disclaimer here. This is not us soliciting to your audience, it's rather sharing some intellectual property at the bank in SBG Securities Research here. But I think it illustrates the point that that the analysts who work bottom up on a number of stocks listed on the JSE, that they see value. Again, they see value in South African stocks, and it's very difficult to pick only 3 from this list. I think in the past, Adi, that I've told you that I like Raubex, for example. That's been one of mine that's been really top of my list. And maybe on another session, we could drill again down into some of the mid caps, which have started to perform very well, the small and mid caps. But what I would say is that a lot of the rally recently for the JSE has been driven by mining stocks, by gold miners, by PGM miners. And there remains quite a lot of value in some of what we would call the SA Inc. Stocks, those perhaps in financial services or in retail. And so I think if I had to pick 3 right now, I would certainly highlight Clicks as one that always offers very solid, reliable value. Also Pepcore, and especially now that the overhang, the sell down by the parent formerly Steinhoff, is done also offers some good value. Well, it would be remiss of me if I didn't mention Standard Bank, which also sits atop some very good value. So there we go. But I'll encourage your audience just to consider that there is value generally in the South African market, and based, picking for the long term, which I think is really the way that we should all approach our investment portfolio. Any one of these
Just to give everyone
be a good bet.
some context here on this, I see Bitcorp says not covered, but just if I'm reading that line, just for everyone, I mean, just from a Standard Bank, the 246 is a buy, and then TP 91, just TP. Just for context, we use a lot of abbreviations in these calls.
Yes. Okay. So what we're showing in each case here in brackets, we're giving you the ticker, perhaps the Reuters ticker as you see it here, followed by the current share price as of the 26th of August. Forgive me, I haven't updated this slide since we shared it with institutional investors, and then our recommendation. So where we don't cover a stock, it's not covered.
Correct.
Where we have a buy, that means we recommend buying the share. And again, this is professional research by our research department that goes to institutional investors. TP stands for target price. So we see value in the stock, whereupon there's an exit multiple that is appropriate. So a target price is showing there's value in our analysts' opinion up to that target price.
Perfect. Thanks, Tom. It's brilliant.
Okay, let's just finish on the MSCI World Market Multiplier, Adi. I think I'm right in saying that books close on our structured product shortly. Is that right?
Correct. So on Thursday, the 4th of September, clients will no longer be able to subscribe to this structure. Clients are quite familiar with how structured products work on the retail base. So 25,000 minimums, they'll be able to buy into these structures, get some return, and obviously have capital protection. But you just want to highlight the top characteristics of this note, considering it is closing on Thursday, Tom, just for the audience.
Yes, indeed. And what I like here, Adi, in particular, is that you're well diversified, holding MSCI World. So not only do you have US exposure, and if there is to be a little bit of turbulence for US stocks, given the incredible rally that they've had, well, you are diversified to some extent across world stocks. But the other point, which I like, and you've mentioned, is that there's 100% capital protection of the amount invested. Okay, so you are protected on your initial investment, and that you then participate in the performance of the index. And the index is the MSCI World 4.5% decrement Euro index. And I would encourage your audience, if you're interested in this, to speak to your OST advisor for more details. That's very important. But you will participate in the performance of this index to the tune of 1.8 times geared. So you have a geared performance to this index with your capital protected. What you do need to do, and you need to be prepared to do, is lock your money up for 3.5 years. 3.5 years is the tenor of this note, and during that time, you either cannot break, you cannot access your capital, or if you do, there are penalties to break. So as long as your audience is aware that the cash is not, the investment is not liquid for 3.5 years, I think that this presents a very attractive investment.
Perfect. Thanks, Tom. Well, yeah, as you mentioned, it is closing, so clients don't have long, but there is more information on the site as well. I see we've come to the end. Very insightful session as always, Tom. Thank you so much for the insights. Thanks for the top stock or the stock picks as well. Something a little bit of flavor to add, especially given that we are in spring and it's the 1st of September. So looking forward to catching up again next week. Thank you so much, Tom.
Happy Spring Day. Thank you, Eddie.